What's going on, everyone? We have a filing to talk about out of the London Clearinghouse. This is going to be a pretty short one, and we're going to have a little bit of help from Gary Gensler on this one. So I'll let him take it away. This is going to be extension of eligible collateral for the London Clearinghouse.
Hello, criminals. Do you how do? Here's another crime pass for you. You fuckheads better slow down. Just leave the glass of milk by my door. Now go. Run away with your relief. Up, 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 and away.
Okay, thanks, Dad. So the purpose of this, LCH SA charges fees on collateral posted by its clearing members to cover the CCP or Central Clearing Party margin requirements. The level of fees is defined based on a combination of various factors, such as operational costs to manage a given type of collateral, ability to generate liquidity from a given type of collateral, and thus the associated impact, the CCP liquidity profile, and commercial considerations such as competitive landscape. The extension of eligible collateral addresses members' demand for more flexibility and consistency with industry standards and market practices. This extension was designed in coherence with the clearing services offered by LCH SA, the profile of the membership and the risk policies, regulatory constraints, and operational capacity LCH SA operates under. From November 1st, 2021, LCH SA is proposing to extend the scope of instruments eligible as collateral to the government bonds issued by the following countries and denominated in their domestic currencies: Australia, Canada, Denmark, Japan, Norway, Sweden, and Switzerland. Huh. You mean the ones in the repo market, Gary? You mean those?
Yes.
Okay, perfect. Yeah, so that's cool. Anyways, in essence, as explained in our approved filing LCH SA 2021-002, contrary to European government bonds, the new collateral scope is not eligible at the ECB to be used as collateral against cash in euros, which in turn impacts how LCH SA monitors and manages its liquidity resources. It therefore represents additional operational costs that are, amongst other things, captured in the pricing difference. That is why the proposed fee change balances appropriately commercial conditions and the impacts on the liquidity of the CCP induced by additional non-euro denominated securities. They're basically getting liquidity, fees associated, and reorganized to help with their liquidity problem that they have. So help us, Gary.
Thank you for watching Shilly's Vides. If you haven't, please unlike and unsubscribe before you leave if you haven't already. Good day.